Good morning. It's Monday, May 5th. Happy Cinco de Mayo. Thanks for joining me. I'm Philip Streible, Chief Market Strategist at Blue Line Futures. So, fun fact, President Trump said on Sunday that he ordered several agencies to rebuild and reopen Alcatraz. Well, I swam that triathlon twice, so I can tell you it is completely escapable, and I can tell you exactly how to map and measure your swim in order to land in Crissy Park. So looking at the markets here overnight and looking at the big headlines over the weekend. So let's start with crude oil. So I had a lot of people texting me over the weekend, and then we could check in on the other markets here and the key drivers for today and this week's session. So looking at crude oil futures, down about 1.5%. They gapped lower down to about 55.30. Currently right now as of this recording, we're just off the highs of the session, and you look at an intraday overnight chart on the 5-minute chart, you can see that prices are starting to close in on that gap. So what happened was OPEC Plus, they agreed to increase the output, raising concerns about global supply surplus and decreased demand due to the trade war. So the output increase was about 411,000 barrels, partly OPEC Plus's strategy for punishing members that win back-to-back market share. So this is leading to short-term price volatility. Basically, what they're doing is certain OPEC members are increasing that production and they are exporting more. And it's to take away some of the other nations that have been cheating, such as Kazakhstan, such as also Iran. Now, you look at Brent crude oil futures, they plunged about 4.6%. And crude oil is one of the worst performing commodities in 2025, in my opinion, making it one of the most interesting, because remember, when you get lower prices, the cure for lower prices is lower prices, and conversely, the opposite side. So when we see crude oil prices go too high, what you'll see is things like corn, things like sugar, things that are turned into ethanol and other different energy products, they'll start to increase their demand, and that's when prices level off. So you start to see a rotation. So at what point does it make it more advantageous to utilize crude oil and boost that demand higher? So we want to keep an eye on the prices, price structure, and things like that. Excuse me. Now looking at the markets overnight here, we are a bit weaker. The S&P 500 down about 0.75%. So we're down 44 points at 55.65. The NASDAQ is down 200 at 20,000, basically evenly. The Dow is down 241 and the Russell's down 16 at 2010. So the S&P 500 had rallied for 2 straight weeks and it notched 9 straight days of gains, but they are turning lower here, and it is looking to snap its winning streak and its best performing winning streak since 2004. Now you look at the earnings here, really first quarter earnings season is drawing to a close, so the focus shifts to the Fed's policy decision on Wednesday. So looking at the Fed meeting again, that'll be the highlight of the week. So they're expected to hold interest rates steady at this meeting. There's only about a 6% chance that they do decrease interest rates by 1/4 basis point. There's pressure from President Trump. He's talking about the slowdown that we're seeing here in the economy. He's seeing that, the labor market's quite healthy, as indicated by that latest non-farm payroll data. And then also we are seeing inflation signs start to ease. So central bankers around the world, they are really facing this uncertainty, what the trade war is going to do, what the tariffs, it's creating a lot of fog in as far as their clarity of where things are going in the future. So a lot of them are expected to keep rates on hold or even cut rates. So several monetary policy decisions are scheduled over this coming week here, with rate cuts anticipated in the UK, Poland, and Brazil, and no change expected in Sweden, Norway, and a few other countries. Now, economic data, we will have the ISM services data for April due out at 9 a.m. and are expecting it to decrease to 50.3 from 50.8. Now the PMI gauge, really the best indicator on it is whether it's above 50 or below 50. It's one of those that indicates either expansion or contraction. With it over the 50 mark, they are expecting still economic expansion. Now you look at the precious metals, gold having a big surge overnight, up 2.45% here. And this comes after recovering from last week's 2.4% loss. It had its first back-to-back weekly losses of the year. The two main drivers have been really that speculative demand here in China and also global central bank buying. So we talked about last week trying to front run when China comes back from their holiday and starts to buy again. And I think that's what we saw in this overnight session. So congrats to many of you that added the positions on that last week's sell-off here, adding to that big $100 down day. and then holding on to positions coming in through when China starts to come back. Now look at the ETF flows here. We did see exchange traded funds. They cut 52,000 troy ounces here and from the previous trading session. They also had cut 4.5 million ounces of silver in that previous trading session. So that was on Friday. A lot of people kind of booked some of the gains. And if you look at the way gold and silver played out on Friday, they rallied up quite a bit and then they sold off. So it was that inverse V-shaped pattern here that we like to look at here and identify. But more importantly, what we do on Mondays is we'll look at last week's changes. So the ETFs, they reduced their gold holdings about 227,000 troy ounces, and they increased their silver holdings by about 3.75 million ounces here in last week. So people are definitely trying to position for some kind of economic recovery here and getting those tariffs and things like that pushed behind us. So the gold silver ratio sits at 101 to 1. The key level to watch is the April 23rd low of 97 to 1. Now Goldman Sachs, they put out a real interesting note here on gold saying that gold is going to continue to outshine silver. They're saying that higher central bank and bank demand in gold is going to continue and structurally lift prices and lift that ratio higher. So they talk about silver and their industrial exposure is really what's leading to the underperformance, and that China's solar boom, which has previously supported silver, has really been insufficient to close the performance gap with gold. They talk about Chinese solar production now slowing from oversupply. They talk about high recession risks, and they talk about central bank buying in the gold market continuing to remain strong in 2025. They also outlined a few different bullets here on why they don't see silver prices catching up to gold in any kind of way here to get that gold silver ratio back down to like 80 to 60 to 1. They say that gold's physical properties make it better suited for reserve management, meaning what they talk about is that central banks, they hold gold for one specific reason, and actually it's two, because of the fact that one, you could fit $1 billion worth of gold in a suitcase, where if you were to do $1 billion worth of silver, it's going to take an entire, truckload in order to do it. So it's just inefficient from the size standpoint. They talk about it being 10 times more scarce than silver. They also talk about just the fact that silver tarnishes and degrades over time, where gold holds its elements and its properties much better than silver. And then secondly, they talk about silver, it lacks the institutional and economic profile that supports gold. Silver is not recognized under the IMF reserve frameworks and has no material presence for modern central bank portfolios. So they're saying that the IMF is also just doesn't have it flagged as something that central banks would want to hold. They talk about it's industrial metal, it's pro-cyclical, and it's less suitable for portfolio hedges. So you look at when we came into this uncertainty around the tariffs, what happened? We saw US equities plummet, we saw gold futures move higher, and it's because of that portfolio hedge aspect that gold is holding up so much better than the silver market, because of the fact that silver is this industrial metal. You need things really to take off, and once things take off, central banks don't really need that. They have other assets that they can manage and other concerns to prioritize. So that's a little bit on the note on the silver market. That does not reflect my opinion. That reflects the opinion of the people that write on that particular report. So I just wanted to give that to you. Now the silver market here up 35 cents, 32.61, kind of in no man's land when you look at the charts here. 32.10 being about the support, about 32.78 being about the resistance point. So we're pushing on up to there. And then gold futures support 32.65, 32.02, and then now 33.65 on the upside. So we'll want to keep an eye on that as well. You do have copper futures continue to work their way up at 472. That's up 4.7% on the overnight session. So if you guys got any questions, reach out to us, send an email, info@bluelinefutures.com. Be sure to register for the research. Probably update the chart pack here with the snapback, and then we'll send that out to you here in the early hours right around that European 10:30 close. So remember, futures and option trading, it does involve risk of loss, and it may not be suitable to all investors. Good luck, good trading.